Hello and welcome to Finance Work. Today we are going to see Annual Reports Analysis Part 1. As an equity research analyst, you should know how to read annual report. But before that, you should know different variables or different pointers in annual report. What do you mean by different pointers? I mean values. Especially income statement, balance sheet, cash flow statement, then footnotes especially. So reading footnotes is an art and you definitely can learn that. Then director's report, management discussion and analysis, auditor's report and shareholding pattern. So you should know how to read these different parts in annual report. Remember, annual report is a report about yearly things. So at the same, when you are actually going for valuation or ratio analysis, it's important to read first annual report. Okay, so once we select the company to research and analyze, the next step is to analyze the company based on its strategic and financial parameters. Strategic parameters we have already covered in the last module, like SWOT analysis. Here we will see which financial statements are important and how to read the financial statements of the company. Okay, so in this chapter we'll cover income statement and balance sheet. Income statement and balance sheet are two most important financial statements in any annual report, and you should know how to read them. So let's see which are the values that are important in income statement and balance sheet. Okay. Reading the annual reports of the company gives the basic information about the company and the industry in which it operates. Reading this chapter would enable you to understand components of financial statements, how to use financial information, and the importance of financial statements for security analysis. We'll start with income statement first. Okay, this is a profit and loss account or income statement for the year ended 31st March 2011 for Reliance Industries Limited, one of the leading companies in India. Okay, if you look at this profit and loss account, starting from income, the revenues, basically it has given a turnover, then excise duty, net turnover, other income, and variation in stocks. If you look at second column, that is schedule, JKLM, these numbers or these alphabets denote names of these schedules, and if you go to these schedules you will understand or you will see detailed explanation of each item. Okay, next is 2010-11 and previous year 2009 and 10. So you can see comparison between these 2 years for every item. So first income, then expenditure, income minus expenditure, profit before tax. Then you have to provide for current tax and deferred tax, then profit after tax. And you need to add the balance brought forward from previous year. Then what remains is amount available for appropriations. Now what appropriations this company is doing? Making first is a general reserve, then debenture redemption reserve, proposed dividend on equity shares, and tax on dividend. So these are typical items in any appropriation. So look at these items carefully: general reserve, debenture redemption reserve, proposed dividend on equity shares, and tax on dividend. Remember, the dividend is given out of this appropriation amount, okay, and rest of the amount is balance carried to balance sheet. Here you can see the all these figures are in rupees crore. So the total amount is 6513.83 crores. So this is transferred to balance sheet. Okay, so below that you can see basic and diluted earnings per share of face value of rupees 10 each, that is basic and diluted EPS. That is 62, and previous year it was 49.65. So definitely there is an increase of rupees 12. So which is definitely greater than 20%, 22, 25%, which is I would say definitely good figure. Okay, this is just snapshot of profit and loss account, and we'll see each of these items in detail now. Okay, so let's move to income statement components. First important part is sales. Okay, so sales is the figure by which you can understand the total turnover or the revenue of the company. Let's say, for example, let's look at example of FMCG major Hindustan Lever. For example, if it is selling toothpaste, so if let's say for example it has sold 1000 toothpaste in a year, so 1000 multiplied the amount of the toothpaste, the price of the toothpaste, that is 50 rupees. So 50 into volume 1000, so total 50,000 is value, that is sales value. Okay, then let's move to other income figure. What is other income? Profit from the sale of assets or dividends from investments or in the shares of the other companies, rent, that is lease rental earned from commercial buildings, or interest received on deposits made and loans given to corporate bodies and others. So these four items, like profit from the sale of assets, then dividends, then rent and interest, so these four items are included in other income. Okay, after other income, let's move to materials cost. Okay, what is materials cost? That is opening stock plus purchases made during the year minus closing stock is materials cost. I repeat, opening stock plus purchases made during the year minus closing stock is called materials cost. Next is employment cost. So employment cost include salaries plus wages plus bonus plus gratuity plus contribution to PF, that is provident fund, plus welfare expenses. So the combination of all these costs is employment cost. Then let's move to operating and other expenses. Okay, operating and other expenses are costs incurred in running a company. So that is, first is selling expenses like advertising, sales promotion, commission paid to salesmen, and the cash discounts. These are selling expenses. Next is administration expenses. What are administration expenses? Rent of offices and factories, municipal taxes, insurance, repairs, printing and stationery, telephone, legal, electricity cost, other expenses to administer a company. So these are part of administration expenses. Other expenses like loss made on the sale of fixed assets and the donations made by the company. These expenses are part of other expenses. Okay. Interest and finance charges. When monies are borrowed from third parties, interest has to be paid. Okay, so which are these interest and finance charges? Bank overdrafts. Money is extended by banks for working capital. Second, term loans. Borrowings from banks and financial institutions to purchase machinery. So term loans are basically for long-term loan. Borrowings from banks and financial institutions to purchase machinery. Fixed deposits. Fixed deposits taken from shareholders and the general public for working capital. Fourth is debentures. Debentures issued to general public and shareholders for long-term capital needs usually. And intercorporate loans. Such loans are taken from other companies for working capital purposes or to tide over a temporary cash deficiency. So this is intercorporate loans. Next is depreciation. What is depreciation? Depreciation is the amount by which the fixed assets have suffered wear and tear during the year. This is the amount set aside from profits so that when the existing asset has been written down entirely, there would be a provision equal to the cost of asset which could be utilized to purchase another. So this is the amount set aside from profits so that when the existing asset has been written down entirely, there would be a provision equal to the cost of asset which could be utilized to purchase another. So you keep some amount from your business to purchase the machinery or fixed asset later. So this is how the machinery or fixed asset is depreciated. Okay. As on account of inflation, a machine cannot be bought at the price ruling 4 years earlier. Right. Many companies provide for an additional amount. For example, earlier you bought a machinery for, let's say, 1 lakh rupees. Definitely, due to inflationary cost that is hovering around 7 to 8%, you cannot buy the same machinery for rupees 1 lakh. So you have to provide for an additional amount. This additional amount would not be charged as depreciation expense, but would be shown as an appropriation of profits that is transferred to general reserves. Taxation. Taxation is a major part, and why taxes are paid? Taxes are paid to the government. Current tax is 30%. Okay. So these are different types of taxes: current tax, then deferred tax. What is deferred tax? Deferred tax is the impact of current year timing differences between taxable income and accounting income for the year, and reversal of timing differences of earlier years. I repeat, what is deferred tax? It is the impact of current year timing differences between taxable income and accounting income for the year, and reversal of timing differences of earlier years. Third is fringe benefit tax. What is fringe benefit tax? It is the taxation of perquisites or fringe benefits provided by an employer to his employees in addition to the cash salary or wages paid, and this is called fringe benefit tax, right? Then let's see what is proposed dividends. Normally the mature companies pay dividends while the growing companies pay less or no dividends. Most companies pay dividends twice a year. Okay, interim dividends. Interim dividends are paid during the year in anticipation of satisfactory results. So these are called interim dividends. Then what are final dividends? This is normally declared after the results of the year have been arrived at. This is recommended by the directors, discussed at the annual general meeting, that's called AGM, and paid after it has been approved by the members at the meeting. So there are two types of dividends. First is interim dividends, which is paid during the year in anticipation of satisfactory results. Next is a final dividend, which is paid at the end of the year after declaring the final results. Okay. Now we have seen all the values or all the pointers in income statement. Let's move to balance sheet. Okay, let's move to balance sheet components. Now here again we are going to check the balance sheet of the same company, that's Reliance Industries Limited. Let's see the different items in balance sheet. Okay, it starts with sources of funds. Sources of funds from shareholders, that's shareholders funds, share capital and reserves and surplus. Then loan funds, secured loans and unsecured loans. So there are two types of funds. One is own and the second is loan funds. Then deferred tax liability, which we have discussed. Application of funds. Okay, application of funds, how the funds that we have and how the company has applied these funds. So buying fixed assets, then investments, then current assets, loans and advances, and then current assets. Okay, so you can check after deducting current liabilities and provisions, you can check net current assets here. Here also you can compare previous year and current year, and there are different schedules given where you can see explanation of each item. Okay, so these are look at this snapshot of balance sheet. We'll check each and every item of this balance sheet in detail now. Okay, balance sheet components. First is sources of funds. Okay, see, as a company you need to have funds, and there has to be some sources from which the company raises its capital. So sources of funds, a company can raise funds from its shareholders or by borrowing. So as we checked earlier, there are two types of funds. One is own fund and second is loan funds. So let's check at first shareholders funds, that's own funds. A company sources funds from its shareholders by either the issue of shares, that is share capital, or by the plowback of profits, that is reserves. Shareholders funds represent the stake the shareholders have in the company. So remember, shareholders funds is share capital plus reserves and surplus. Share capital. Now there are different types of share capital. What is authorized share capital? Okay, authorized share capital is it would depend entirely on the promoter's estimate of the funds required by the business to purchase its assets and fund its working capital. This is about authorized share capital. Now share capital is issued in a number of ways. Okay, first is public issue. Shares are offered to the public at large, that is called public issue, and private placement. So private placement shares are offered to selected individuals or institutions, that is called private placement. Third part is rights issue. Existing shareholders are offered as a matter of right shares in the company in proportion to the holding they have. For example, 1:4. Reliance, for example, Reliance in 1987 offered rights shares at rupees 60 to the existing shareholders when the market price of the share was rupees 120. I repeat the example. Reliance in 1987 offered rights shares at rupees 60 to the existing shareholders when the market price of this share was rupees 120. So keep in mind the importance of rights issue. Next is bonus issue. You might have heard, or we have seen this bonus importance or usefulness in Wipro example in Magic of Equity chapter. Okay, so bonus issue here, no monies are raised. Existing reserves such as the premium on shares issued or profit plowed back are capitalized or converted to bonus shares. Here the pattern of shareholding will not change, as these shares cannot be refused and allotted in proportion. Now what's the main purpose of bonus? The main purpose of bonus issues are, apart from pleasing the shareholders by giving them additional shares, to widen and strengthen the capital base so that the foundation for growth is tangible, real and solid. So remember, in bonus issue money is not raised and existing reserves are capitalized or converted to bonus shares. What are reserves? Reserves are profits or gains retained in the business for growth or expansion. I repeat, reserves are profits or gains retained in the business for growth or expansion. Now let's see different kinds of reserves. First is capital reserves. Capital reserves are reserves that have resulted from the increase in the value of assets. I'll give you an example here. Example could be share premium account. Now this arises from the sale of shares at a premium. For example, the share premium account, capital revaluation reserve and the capital redemption reserve. So these are part of capital reserve. For example, Reliance issued right shares at rupees 60 with rupees 50 as premium. Okay, so now this 50 premium will go to capital reserves. Now let's see what is capital revaluation reserve. This arises when assets acquired many years earlier, such as land, is revalued at current market price. This can only be mentioned when the gain is realized. So remember, this arises when assets acquired many years earlier, such as land, is revalued at current market price. For example, ABC Limited purchased a land at Andheri in 1950 at rupees 50,000. Okay. Now the revaluation of the land comes to rupees 1 crore as per today's market price. So the land will be shown in the balance sheet at current market price, that is at rupees 1 crore, and the difference of rupees 99 lakh 50,000, that is 1 crore minus purchase price, that is 50,000, is equal to 99 lakh 50,000. This would be shown as capital reserve. All right. Now let's move to loan funds. What are loan funds? Loan funds definitely are debts primarily. Okay, so loan funds can be divided into secured and unsecured. Secured loans. Secured loans are those that have been taken by a company by pledging some of the assets such as land, buildings, stocks and debtors. The usual secured loans that a company has are debentures, bank overdrafts and long-term loans taken from banks or financial institutions for the purchase of machinery or some other long-term asset. Let's see what is unsecured loans. Unsecured loans are loans taken by the company for which the company has not pledged any of its assets. The security the lender has is usually the credit worthiness of the company. These are usually fixed deposits and short-term loans. At times, banks give overdrafts against which they are not required to hypothecate stocks or debtors. These are known as clear overdrafts and shown as unsecured loans. Fixed assets. What are fixed assets? Fixed assets are those assets that a company owns for use in its business. The kind of fixed assets a company would own would vary enormously from company to company. A manufacturing company's major fixed assets would be its factory and machinery, whereas that of service industry would be its office building. So look at Reliance and Infosys and check their fixed assets. So look at their balance sheets and check their fixed assets. Definitely Reliance Industry would have fixed asset like machinery, factory, and IT services company like Infosys would have office building as its fixed assets. Similarly, a transportation company's major fixed assets would be its trucks. So you understand, basically the fixed asset is used in business to earn returns. After fixed assets, we'll move to depreciation. So let's check what are depreciation methods. There are two methods, the depreciation methods used primarily. First is a straight line method, and second is reducing balance method. Okay. Except land, all other fixed assets are depreciated over their useful lives. Land is appreciated, it's not depreciated. Okay. So I repeat, except land, all other fixed assets are depreciated over their useful lives. Capital work in progress. What is capital work in progress? Projects like construction of a factory or installation of machinery which is not complete. I repeat, projects like construction of a factory or installation of machinery which is not complete and which are of capital nature are known as capital work in progress. Investments. What is investments? It is a deployment of short-term funds. Trade investments is a kind of investment. So what are trade investments? Trade investments are shares or debentures held of competitors or others in similar businesses. Many companies have nominal holdings in their competitor companies. Why this is done? Why you have to hold nominal shares of competitor companies? This is done to have access to information on their growth, profitability, and other important matters. Investments in subsidiary and associate companies. Okay, after we have checked traded investments, let's move to investments in subsidiary and associate companies. Companies hold shares in their subsidiary and associate companies. The United Breweries Group and the Tata Group are prime examples that have an intricate cross ownership of group companies. Other investments. There are shares or debentures or other security held that is not in any way trade or subsidiary investments. It is this category that companies invest their surplus cash for profit and income. So this is called other investments. Now what is quoted investments? Quoted investments are those shares or debentures that are quoted in a recognized stock exchange and are traded. If you look at any annual report and go to investment section of that company's schedule, so you will see there are quoted and unquoted investments. So let's move to unquoted investments now. Unquoted investments are shares of companies, usually private companies, that are not quoted in a recognized stock exchanges. So quoted are quoted in a recognized stock exchange, and unquoted are not quoted in a recognized stock exchange. Okay. Current assets. What are current assets? Any assets that are turned into cash within a year is considered a current assets. I repeat, any assets that are turned into cash within a year is considered a current assets. Now let's see examples of current assets. Cash and cash equivalents, stocks, that is inventories, raw materials, work in progress, finished goods, loose tools and spare parts, then trade debtors, prepaid expenses, other current assets. So these are examples of current assets. Loans and advances. Loans given to staff members or other companies, and secondly advances given to raw material suppliers or other contractors come under this heading. Current liabilities and provisions. Like current asset, current liabilities are amount due and payable by the company within the next 12 months. Provisions. Provisions are amount set aside for a likely payment or expense which is estimated and likely to be incurred. So provision is kind of money set aside. What are examples? Examples would be trade creditors, accrued expenses, sundry creditors, provisions for proposed dividend and taxation. So these are part of current liabilities and provisions. Revenue reserves. What are revenue reserves? Profits are appropriated and transferred to general reserves for various reasons such as plowback, increasing shareholders' funds, and thus commitment meet unexpected expenditure and provide funds to purchase machinery and other assets at a future date. These are revenue reserves and can be distributed to shareholders as dividends. For example, profit and loss account, general reserve and the likes. So with this we'll finish this chapter, that is reading annual reports part 1. In second chapter, that is coming chapter, we'll check footnotes and cash flow analysis.